Hey there, here with another video on the journal entry process and just the thought process that goes behind preparing any journal entry. We're using these videos to kind of help us to get an idea or get our minds flowing whenever we see a transaction and understanding how to get from transaction to an actual journal entry. So we're still following the 5-step process. In this example, we're going to go with this transaction that's on the right. It says Brennan and Company decided to rent an office space for $600 a month. Payment was made for the first month's rent. So, here we go. First question, what's happening in the transaction? Well, what did the business actually do? One thing the business did do is the business made a payment. They paid rent. And so that's one thing I can put here. Business paid rent. Did the business do anything else? Well, we can say that they paid it with cash because we're saying that they spent $600 for the month. And so that was paid with cash. And pretty much that's it. The business paid rent and they paid it with cash. So that's what happened in this transaction. Actually forgot to put a date on this, so let me put the date for July 2020. Okay, so based on what's happening in this transaction, what accounts are going to be affected? Well, we know that there are not 4 types of account. The types of accounts are assets, liabilities, owner's equity accounts, revenues, and expenses. When we think about this transaction itself, the business paid rent. Rent is actually an expense to any business because that's a cost to be in business. And so one of the accounts that I would say is affected would be rent expense. That's one of them. Let's insert. So rent expense is one of the accounts that's affected. And like we said, there are always 2 accounts that are affected by a transaction. And so what else is changing in value? Because now we're saying, okay, the rent expense, the amount that we paid in rent for the period is going to increase. And the fact that we paid it is going to increase. Why? Because we're saying that we spent cash. So we have to record that cash is leaving the business and going to whomever we pay the rent to. So cash is also another account that's going to be affected. Cash, rent expense. So the question comes, how are the accounts affected? Well, how are they affected? Are they increased or are they decreased? Do I need a debit or do I need a credit? So let's start with the first account. The first account we specified was cash. How is cash affected when we pay rent? Well, cash is affected because we're spending money. So we're no longer going to have that $600 to spend anymore. So that means the value of the cash I have after making a payment is going to decrease. So cash is going to decrease. And so I understand it's going to decrease, but what do we do to the account called cash? How do we make it decrease? Well, we first have to figure out what type of account it is. A cash account is an asset account. In order to decrease an asset account, we have to credit. So let's credit the account, which is the cash account. That's all we need to know about the first account. Second account is rent expense. Rent expense. What is actually happening to that account? Okay, so we're paying rent expense. That means it's an additional expense that the business has. So what does that mean? Well, if it's an additional expense, think we have to increase the amount of expenses that we've paid for rent for whatever period of time. So that therefore means that the rent expense account we have to increase. And we should know what type of account this is. This is an expense because it says rent expense. That's a cost of the business. So it's an expense. An expense account. How do we increase or decrease expense account? Well, we should remember that expense accounts mimic asset accounts. And so asset accounts increase with the debit and decrease with the credit. So expense accounts do the exact same. Increase with the debit, decrease with the credit. So then that means that our rent expense, if we're going to increase it, we have to debit that account. Okay, so let's take a look. We look at the two accounts that we have. Do we have a debit? Do we have a credit? Because we should remember from double entry, there for each transaction there is a debit and there is a credit. Okay, and so we have a credit, we have a debit. Now, how much should each account be affected by? Well, the only thing that happened in this transaction was they paid $600. So that means cash has to decrease by $600. Rent has to increase by $600. So the value is just $600. Like I said in a previous video, sometimes this question is more complex depending on the transaction itself. But because this is a simple transaction, we don't have to worry about that. But I can go into detail in another video on how we may deal with transactions that are a bit more complex. But for this one, this is pretty simple. So now we determine what happened. We determine which accounts are affected. We have determined how those accounts are affected and by how much. So now all we have to do is take the information that we've already found out and put it into a journal entry in proper form. Proper form being there's a certain way that journal entries are prepared. We would prepare them that way. Okay, so the date here, I added that in. They're paying me the first month's rent for July 2020. So let's just assume in this instance, they normally tell you the actual date, but we're going to assume that we're paying this for the first of the month. July 1st, 2020. Sorry, I like to see the actual word. So bear with me in my pet peeve here. I like it because I can't really tell. I mean, I could assume that that's either July or that's January. I like it to say July. So extra, attention for those that do that. Yes. Okay. So let's continue on with this journal entry. We have the date. We only need to write the date once. So the date we're going to assume is July 1st. Normally you pay rent at the beginning of the month, I guess. I don't know. I don't pay rent, but yes, I'm assuming we pay rent at the beginning of the month. Some businesses do, some businesses don't. In this instance, we'll assume that we're paying rent on the first of the month. And so now we need to make a record of our accounts that are going to be affected. As a reminder, again, we actually need to make sure that our debits are on the top and our credits are at the bottom. So rent expense is the account that we say we're going to debit. And so that's the first account here, rent expense. The second account is going to be cash. And so we have cash. Okay. And you could have just pressed indent, but I'm covering it up. But next thing we do, we have our accounts shown, rent expense and cash. And cash is credited, so it's at the bottom, it's indented. Rent expense is debited, so it's at the top, and it's not indented. And so now we just have to put in our figures, which we're saying that both accounts are are affected by the same $600. So our debit account, rent expense, we would put underneath the debit section $600, and the credit account we would put underneath the section $600 as well. And so pretty much this is what the journal entry would look like. That we have our debits, we have our credit, and we can see that our total debits and our total credits balance. Normally what we do, we also try to put some type of description that's necessary. So we can say that the company paid rent for July 2020, and that gives us a synopsis of what we're actually recording. So that's really important. It's important to be able to describe the transaction without using all of the words that are here. And so yeah, so this is another good example of the journal entry process and preparing a journal entry.